How to trade in futures and options and make money. Price changes are the only constant in the financial market. Investors in the financial market will be concerned about price fluctuations because changes in prices mean either losses or profits. They use derivatives such as futures and options to protect themselves. If you're not sure what futures and options are, watch this video. What are derivatives? A derivative is a contract whose value is derived from underlying assets, which could be stocks, commodities, currency, or other assets. What are futures and options? Futures and options are derivatives whose value is derived from the underlying asset. A futures contract is a security conceptually similar to a stock or a bond. In this type of contract, a buyer, or seller, agrees to buy, or sell, a specific quantity of an asset at a specific price at a future date. Options give a buyer or seller the right, but not the obligation, to buy or sell stock at a specified price on a future date. The distinction between a future and an option is that the latter allows you to choose not to exercise the contract. Weather risk. Futures contracts are available for a wide range of commodities, not just the most common ones. Some futures contracts are even designed to protect investors from weather risk. Future and option trading in the stock market. One advantage of futures and options is that they can be freely traded on various exchanges. The significant advantage of investing in futures and options is that you do not have to spend money on the underlying asset. Regardless of experience, different people fare differently depending on their trading ability. Investing in futures and options trading entails some risk. You must be active at all times. Options carry less risk because you can choose not to exercise them if prices do not move as expected. Only if you're serious and committed will you see success in the trade. Futures and options in commodities. Commodity futures and options are another option for investors. However, because commodity markets are volatile, you should only invest in them if you are willing to accept a significant amount of risk. Before you begin trading futures and options, you should understand what you're getting into. We have elaborated on some of the key questions that can guide your research when considering trading futures and options. Are you trading an Indian or a foreign option? Standard contracts for exchange-traded options are more liquid and can be hedged better against risk. This is not always the case with dealer-traded options. Who is securing the transaction? Foreign institutions may not adhere to stringent standards and may be poorly monitored. If you are trading with foreign institutions, thoroughly examine their individual futures and options contracts. Are you paying an unnecessary premium? Independent dealers may charge a very high fee and conceal it under the guise of premium. It's important to understand that you pay the option premium plus a commission fee. How to communicate with your broker. Maintain regular conversations about your futures and options trading. Determine how you and your broker will communicate and how often. Please carefully read and understand the terms of the management contract before putting any money down. Futures and options trading is not as complicated as many people believe it to be. A thorough understanding will undoubtedly help you in making better use of these innovative financial products. Check out this space for more stock-related videos from Accordience Business Services.